For me, as a value investor, what I'm trying to look for is a good future stream of earnings in a company. I mean, at the end of the day, that is really what I care about, is the future earnings stream. And as an investor, really, in a company, as an owner of a business, that's all that you should be caring about too, is really the future stream of earnings and its predictability. So if we were to simplify the modern value investing approach and break it down comprehensively, all it comes down to is the future stream of earnings. Meaning, everything else that we look at, whether it's the current ratio, whether it's all the items on the balance sheet, whatever you want to consider, the amount of debt that the company has, the cyclical nature of the business, the competitive advantages, all those come down to, ultimately, is the predictability of the future earnings stream. That's all that matters. So I'll give you an example. We don't want companies with a lot of debt. Why? How can we predict what the future cash flows of the company are over the next 10 years if the company has a lot of debt? The company could go bankrupt before that 10-year period even elapses. So when we look at certain factors that are adjunct to a good company, the reason why we're looking at them is because we want to be able to predict that future stream of earnings over the next 10 years, let's say. That's really what it comes down to. So when you start thinking of yourself as let's say you buy a company, so you're now the owner of that company. What you care about is the future stream of earnings. I mean, that's all that really matters, the amount of money the company makes. And the more confidence we can have in those predicted future stream of earnings, the more we can be confident in our investment choice. And really, confidence in the future stream of earnings is only going to come down to a handful of factors. One is going to be the company's competitive advantage. Another is going to be its management. Why do we care about management? We care about management because how can we predict that future stream of earnings if the company's management is incompetent? They can drive the company bankrupt. They can screw up a whole bunch of things. So everything comes down to the future stream of earnings. That's really my point. You should always have in your mind a simple philosophy of what it is that you really care about as an investor. And for me, as a modern value investor, I care about future stream of earnings. I mean, that's all that really matters at the end of the day. How much money is the company bringing in? Is it growing? But to figure that out and to predict the future stream of earnings, that's really the skill. And in order to do that, that's when we look at all those other factors: debt to equity, current ratio, is the management competent, are they candid with their shareholders, what are the long-term future prospects of the company, do they create products or services that have a large fan base? Why do we care if they have a large fan base? Because then people will keep on coming back, so that increases the predictability of the future stream of earnings. Why do we not want cyclical businesses? Because cyclical businesses have future earnings that are difficult to predict. All that it comes down to, every single point on all of our checklists as value investors, come down to the predictability of the future stream of earnings or future cash flows, whichever term you want to use. In my mind, they're essentially equivalent because, true earnings really in my mind are cash flows. So we're trying to figure out what that stream of future cash flows or owners' earnings are. And the only way we can really do that is if we have companies that meet our checklist criteria. That's why we create a checklist. That's why we have a checklist, to figure out what are those future stream of earnings. And not even necessarily to figure out the future stream of earnings, but more so to determine if we can even begin to predict the future stream of earnings. So when I'm looking at a company, the first thing that I look for is earnings consistency. So I'm looking at a company's cash flows and earnings over the last 10 years. If they're cyclical, I move on to something else, because there's no point in me trying to predict the future earnings of a company who has cyclical earnings. I mean, by definition, it's impossible to predict. So I just move on to something else until I see earnings consistency. If I see a company has earnings that are going up and up and up and up, whatever, revenues that are going up and up and up, then that's something that is predictable. There's a trend there. I can try and estimate. And if the company has good long-term prospects, then I can be even more confident of my future earnings. And if the company does not, has a growing market share and places to expand, then that gives me even more confidence. And then if the management is super competent and they have high returns on equity, high returns on capital employed and invested capital and so forth, then that gives me even more confidence in my ability to predict the future stream of earnings. So my point is, first you should look at what is you're trying to figure out. when you're investing in a business, you're trying to figure out what that future stream of earnings is. That's all that it really comes down to. All these other points then support that prediction. And if you find that a company has too many variables that aren't, let's say, positive, like they don't have, they have too much debt. So, if they have too much debt, they can go bankrupt. If they go bankrupt, that future stream of earnings won't exist. Then you can then move on to something else. But the point is really, have a philosophy. What do we care about? We care about future earnings stream. That's all that matters. That's my philosophy. I care about the future earnings. Then from there, I devise a checklist saying, okay, in order for me to be able to predict that future stream of earnings, the company needs to meet certain criteria: low debt, competent management, a product that's going to be relevant. I mean, if the product isn't relevant in, let's say, 10 years, then there's no future earnings. So what I'm really trying to get across is, as a value investor, as a modern value investor, have a framework, have a philosophy. It's future earnings for me that matters. Everything else supports that philosophy, that core philosophy of future earnings. So when I'm looking at a company and I'm analyzing its balance sheet, for example, I care about, how does this balance sheet affect the future earnings? Does it have too much debt? Can it meet its obligations? Yes, well then it doesn't really, at the end of the day, that's really what counts. So I want you guys to write down, you can write down what your investment philosophy is. And it should be a short sentence, and then everything else should then kind of, assist and help you get what your ultimate goals are. And for me, it's to be able to see good future earnings, to have future earnings that are predictable, and then I can go from there. I devise a checklist based on the predictability of those future earnings, and you're golden. That's personally what my way of doing it is. So for me, it's future earnings predictability that really counts. I look for companies where I can predict those future earnings, and my entire checklist is designed to support that one philosophy, which is future earnings. Are they predictable? Are they sustainable? Etc., etc. Thank you for tuning in. I hope you liked the video. Like, comment, and subscribe.